Hey, Cashflow Ninjas, real quick before we jump into today's episode. I've been asked by many people recently, what has been the one thing that has made all the difference on my journey as a business owner and investor? I started businesses and I've invested in businesses. I've invested in single family real estate, multifamily real estate. I still have a sizable portfolio of multifamily real estate, historic resorts, mobile home parks, oil and gas, life settlements, gold and silver, Bitcoin and cryptocurrencies. I could go on. But the one thing that has changed the financial trajectory for myself and my family has been infinite banking. Yes, you heard that correctly. That is the number one thing I've done over the past 2 decades that have made the single biggest difference. And it's not even close. Setting up and building out a family banking system using infinite banking has enabled me to create my own financial system. This year, it has allowed me to focus and not pay attention to all the chaos in the global economy and global financial markets. I really don't pay attention to all the noise about tariffs, trade wars, markets violently going down and then going back up, or interest rates skyrocketing and wrecking real estate deals and other alternative investment deals. Do not be beholden to other systems. Create your own system. If you're interested in working with me and my team at Producers Wealth to set up your own banking system or your own business and family banking system, then go to getwealthyforsure.com. That's getwealthyforsure.com. When you go to getwealthyforsure.com, you can request a free copy of my best-selling book, Get Wealthy for Sure. Only pay for shipping. You can also watch all of our presentations and schedule a call to explore infinite banking options with me and my team. You don't have to be powerless amidst the chaos. You too can have a financial strategy that provides certainty, predictability, and clarity. You and your family can also get wealthy for sure. Go to getwealthyforsure.com to start your journey today. The world is going through changes. Changes happening at a speed that we have never seen before. This is leading to disruption, chaos, panic, fear, hysteria, and a turbulent economy and marketplace. How do you protect your wealth in a turbulent world? How do you invest for cash flow in alternative assets to escape the rat race in times of uncertainty? How do you decentralize yourself, your family, your community, your business, and your investments to become sovereign and escape the matrix? If you are looking for strategies, tactics, and techniques to escape the rat race and matrix, you are in the right place. My name is MC Laubscher, and this is Cashflow Ninja. This is Cashflow Ninja. I'm MC Laubscher. Thank you so much for joining me for another episode and spending your most valuable resource, your time, once again with me on the show. Everything Cashflow Ninja is at cashflowninja.com. Cashflowninja.com. We've got over 1,000 podcast episodes, 4 books, reports, webinars, and much, much more, all at cashflowninja.com. And don't forget to subscribe to the #1 newsletter in the alternative wealth strategy and alternative asset investing space, the Wealth Dojo. You can subscribe to the Wealth Dojo by going to cashflowninja.com/subscribe. I've got a fantastic show for you today. I'm joined by real estate investor Aaron Fragnito. Aaron, it's great to see you.
MC, how we doing today, my friend? Great to connect again.
Yeah, absolutely. It was great to recently reconnect with you, and had a great chat. So I've been looking forward to this one and sharing you again with my audience, my listeners and my viewers again. If you have not heard Aaron's previous interview on my show, just go to cashflowninja.com, type in Aaron Fragnito.
You'll see the previous episode we did a couple of years ago. You always deliver a ton of value. So excited to get into this one. But Aaron, for my new listeners and viewers, and maybe listeners and viewers that's not familiar with you and what you do and get up to these days, can you please share a little bit about your background and journey with us?
Sure, MC. Well, I'm just honored to be on the show. The original ninja here. You've been around almost a decade here in this podcast space, right? So the OG of real estate podcast. Second time guest, long time listener. I have been investing in real estate here in New Jersey since 2011, actually, and met my business partner at a real estate networking event. I was speaking in front of the crowd there. My topic was "Fake it till you make it." And I was just getting started in real estate. I read a book called Rich Dad Poor Dad, of course, the real estate investment Bible, and realized my passion for real estate investing around 2009, 2010. Graduated from college into one of the worst job markets ever. So I said, okay, I want to be a real estate investor. I read a bunch of books on real estate investment and started as a realtor. Learned the market that way. Had a pretty nasty partner at first, and eventually met a good business partner who I have to today, Seth Martinez, who handles the operations of our company. And, we started with staple and signs to telephone poles, and they say we buy houses. And I bought a 6-family in Newark, New Jersey for $220,000, put about $80,000 into it, refinanced our money back out, and said, wow, this is amazing. That was the aha moment where we can kind of recycle capital, keep buying properties, and use the buy, renovate, refinance strategy to do so. And then we invited more investors along in additional deals in the future. Started buying bigger and bigger properties, developed a management company around 2015, fixed and flipped a lot of houses, wholesaled a lot of properties, did small multis, large multis. And but we're strictly focused on New Jersey here. So we've completed about 280 transactions here in northern New Jersey together, Seth Martinez and I. And we built a nice portfolio valued a little over $40 million here in the North Jersey metro area. So we focus on Class C and B assets that are located within about an hour commute to Manhattan in northern New Jersey. So that's our recipe for success, buying these kind of older vintage properties off market for great prices and repositioning them, improving them, making them nicer places to live for our tenants and creating more revenue for our investors with our in-house management company. And then, harvesting that equity growth through a refinance and sale over time. That's what we focus on, my friend. Strictly North Jersey here. We try to be experts in our market here.
Yeah. So you're one of those guys that you stayed in your own backyard, right? Where a lot of people look at different places all around the country and look at other markets to invest. What competitive advantage do you feel that you have too, being in your own backyard and just staying right there?
Well, first of all, you make your money when you buy in real estate. And brokers don't like putting properties on LoopNet or on CoStar on the open internet. It's really, you're not going to find great deals out there. Brokers that have great deals have an A list of buyers, and they call those buyers up. Normally they have a buyer at the very top of that list, and they might call that buyer first and give you a shot at the deal. You maybe have a 3 or 4 day window to underwrite the deal, go out, take a look at it, and submit a letter of intent. Generally, brokers don't want to deal with like a million different buyers. A good buyer is going to put a pretty strong offer forward, and most bids are going to come in right around that number. So if you can put forward a decent offer on a property, you're going to get ideally an off-market deal with no other buyers on the property, no other bidders against you, and be able to get a great price on that property. So you make your money when you buy by knowing the brokers, knowing the wholesalers, the landlords, and going direct to the deal and not bidding against a million other buyers on the market. Secondly, the boots in the ground, the infrastructure, the management, right? Knowing how to lease out these properties quickly, working with good contractors that are off market as well, kind of, under the radar contractors, that we worked with for years that give us very good prices and do great work. And they're not marketing, they don't have their names on the truck. These are guys that are kind of under the radar, great priced contractors that we work with on our properties, and just having a good staff, quality people here. I mean, it is so hard to take a Class C mismanaged apartment building with rents below market value, renovate the units, turn over the units, improve the common areas, improve the management. It is such a heavy lift that I couldn't imagine doing it 6 or 7 states away and not being able to have the ability to drive by your asset or have your own management company in place. I mean, I've hired multiple management companies, and they don't treat your baby the way you're going to treat it. They just don't. You're a number on a spreadsheet. You're a client to them. They might give you monthly or weekly reports and stuff, and check off the boxes. But man, I cycled through 2 management companies before we developed our own because they just weren't making the cut. And it is a much heavier lift. Listen, I mean, if you're buying Class A buildings and they're turnkey and you're kind of just sitting on them and collecting the rent, and you call the snow company in the fall and you call the landscaper in the spring. Yeah, I mean, that's a standard management building. That's fine. You could probably work with third-party management, be many states away, and be all right on that, kind of Class A core plus real estate. But man, opportunistic, heavy lifts, heavy management, you need to be in that market, get the right prices, have the right service providers, be on top of your staff. So that's another, great advantage of being local to all of our properties here.
Tell me a little bit about the market that you're in and what makes that attractive for you as an investor.
Well, people need a place to live, and there is an insatiable demand for housing in the New York City metropolitan area. Some say the greatest city in the world, MC, is New York City. And there are just so many people living in one place here, right? New Jersey is the most densely populated state. So we have a lot of people that need to live somewhere. It's very expensive to live here. It is 30% more expensive to own a home in New Jersey than it is to rent a home. And rent keeps on growing here. A lot of people say, oh, it's a blue state. Why would you invest in a blue state? Well, I'll tell you why. Because it is harder to develop new real estate here. Therefore, new developments come on market slower. They cost more. They're less likely to even be built at all. And that means a low amount of inventory is hitting the market. Our saturation rate in Jersey here was about 19,500 units last 4 quarters, and we built about 16,000 units. So we are 3,000 units short approximately per year here in New Jersey. And we're not building fast enough, and housing starts are down over the last couple of years because rates are high. So there's a shortage of housing. A lot of people don't want to live in New York City. They want to live in beautiful northern New Jersey with a nice backyard. We have good schools. We have incredible Fortune 500 companies. You can dance the night away in Hoboken. You can go to the Jersey Shore and get your tan on. You can go skiing in Mountain Creek or hiking. We do have mountains. We do have like a beautiful rural areas here in North Jersey too, but we have great cities and nightlife as well. And you kind of have it all. That's why it's so expensive to live in Jersey. You can get a quality education at Princeton or Rutgers, and it's just really a nice place to live. I'm born and raised here in northern New Jersey in the suburbs of Jersey, and it's a great place to raise a family. I raised my own son here. The schools are great in the right areas. So, we see a consistent demand for housing, a consistent shortage of housing. And if you learn to navigate the higher taxes and insurance costs and some of the red tape, listen, it's just another number on a spreadsheet. Oh, the taxes are high. That's just one of like 15 to 30 expenses on my spreadsheet. So, there's pros and cons to every market. If it pencils out, we're targeting 20 IRRs to investors. We're very competitive with red state opportunities.
So because of the red tape that you guys have to jump through, that actually gives you a competitive advantage because a lot of people they would just look at it and go, there's no way I'm dealing with that, and look somewhere else. So less competition, and then obviously opens up more opportunities because of all these, I would say, stricter regulatory kind of environments, right?
Yeah, less competition and less new development hitting the market. You look at areas like Phoenix and Fort Worth and Florida and so on, even the Carolinas, you have a lot of inventory hitting the market because it's easier to build and develop there. So naturally, if you're a real estate developer, you're going to go to an area where there's less friction to getting that building off the ground. That means more inventory hitting the market more quickly. That's not very great for your existing inventory because eventually those markets do get oversaturated. Now, in time, they'll get those units will get saturated, and there'll be and then there'll be more building, and then those will get so those markets aren't terrible, but you don't really see that as much in these Northeast markets where there's a lot of red tape. So, and if you learn, I'm going to write a book called How to Navigate the Red Tape in a Blue State. That's my next book.
There you go. And how's the portfolio overall performing? And what are the things that you're seeing in the market? Current changes, positive things, some challenges? What are you seeing?
Yeah. So, another thing about investing locally here is understanding how to navigate that red tape, as my book will detail. And basically, you have the 5-year green card, which is a state inspection you got to work through. But we just know how to kind of pass that and what to expect for that. But overall performance is strong on our portfolio. We're selling an asset right now, a 25 unit in Paterson, New Jersey. We'll be achieving target returns to investors through the sale of that asset. We have a nice property in Rahway, New Jersey that's churning out very strong cash flow to investors. We have a building in Bayonne we're working along nicely with, and hope to sell that over the next couple of years. And we're selling an 11 unit in Paterson, a smaller asset from kind of our years of getting started that is ripe for sale. Now I've kind of squeezed all the juice out of it. We'll do very well to investors on that, ideally about a 19-20% annualized cash on cash return. And right now we're seeing great deals. I mean, there's so many deals to buy in this market. It is like real estate is on sale. Interest rates have been high for a couple of years. Prices have come down 20%. Rents continue to grow 5 to 8% in a lot of these markets. So rents are going up. Prices are coming down. Yes, the cost of debt is higher, but again, that's just a number on our spreadsheet. And if all the other numbers are looking better, then you can be in a good spot. And insurance has actually come down a little bit, surprisingly. So, I think it's a great time to be buying real estate, especially in this North Jersey market. And the types of real estate we buy, kind of these vintage properties, they're on sale right now. It's incredible. So, overall, so good so far. Yeah.
What's a filter that you're looking for if there's a deal? What is kind of like your checklist for a property in that market?
So we like properties with value add, right? It's quite simple. When you're looking at an opportunity for your investor base, you need something that there's meat on the bone, as they say. There's profit to be made. We're not just buying core plus assets and sitting on them and trying to clip a 4% coupon every year. We are buying buildings where rents are 40, 50, 60% below market value, mismanaged. These units really haven't had enough money put into them through the years. Maybe there's a partnership dispute going on and the partners just want out of the deal. There can be a lot of just overall deferred maintenance throughout the property, or even situations with the landlord and their lender going on where they need to get out of the deal in a timely manner. So we see all that happening, and we do recognize, that because of that there's great opportunities. Generally what we find is, these off-market deals with these motivated sellers are a great recipe for a buyer. And if you can say, okay, we can come in at a discounted price, we can increase rents 40 or 50% on this asset over a 3 or 4 year period. We can then refinance a big portion of the investor's capital back to them and then sell maybe over a 5 or 6 year period. Then you're looking at returns north of 2x over a 5 year period. Right now we're targeting a deal where we have a 20% IRR, a 2.2x equity multiple over a 5 year period. And that's not even including the 50% tax write-off you get in year one of investing. So it all, the bottom line is, what's the IRR we can make investors? Is it 20%? Is it north of 20%? Then it's a deal we're going to look further into. If we can't achieve a 20 IRR to investors, then, or if it's class A, maybe it's like 16 to 17, then we're not going to be moving on it. So that's the first KPI, the first metric we look at is what type of return can we make our investors with this deal? Everything else is a number. You're going in cap rate. That's just a number. I mean, it's just a distressed asset. Rents are low, expenses are high. Yeah, you're going in cap rate's probably going to stink, Your price per door. Well, that's all depends where it is, depending how old, the vintage of the building, and so on. These are just variables that fluctuate per opportunity. It all goes back to what's that IRR you're going to get your investor. And if that's around 20%, we're going to dig into the underwriting further and probably submit an LOI.
And then financing, what are you seeing there? Because that's an area, obviously, where a lot of operators got caught with floating debt and that kind of stuff. What are you seeing there, and what are some of the things that are working there?
Yeah, we didn't get floating debt. I mean, rates were obviously going to go up. They couldn't go any further down, So, I mean, you had to be pretty short-sighted to not recognize that, But, I mean, listen, we have deals that, have a 5 year fixed, right? And we locked them in 4.5 years ago, but we've done great renovations to them. That's the beautiful thing about value add. You're buying it at a discounted price. You're renovating the building. You're creating a lot more revenue out of this building. So even if prices drop like they have now, even if rates go higher like they are now, there's still generally a good amount of profit to harvest from the investment. So we are selling a couple buildings where rates are expected to the 5-year fixed is up like at the end of the year, but we've hit our mark we were planning to sell after this period of time. We've repositioned the asset to a nice stabilized position, and now it's time to sell. So we want to achieve our project timelines for our investors, and if you kind of priced in this potential of the cap rates increasing and interest rates dropping, increasing, then it's all part of the business. So we're in an okay spot on a lot of these deals, pretty much right on target. And the cost of debt is what it is. We're looking at bridge debt for a lot of these buildings we're buying. Right now, I'm buying a building with a bridge lender. We're looking at about 8.5% interest rate, and a point in, no points out, which is nice. But we're getting 75% of the cost of the project. That's 70% of the purchase price and about 100% of the CapEx. So they're allowing us to leverage our investors' capital wisely, and then we'll take them out with a agency debt after 3 years once the building's stabilized. And it's just another number on the spreadsheet. So it all works into context. But if you're spending a lot less for the real estate, then you're getting a better price on it, then the debt can make sense. The last building I bought, I had a 5.4 interest rate. Locked it in the day before the September Fed meeting, which was the best day of 2024 to lock in an interest rate. Happened to be the day I locked it in. As they say at MC, it's better to be lucky than smart. And I think that was a case there of that. But 5.4 is not bad. I did a 2-point buy down, locked in a Fannie Mae loan product, agency debt, bought a 42 unit in Passaic. That was in December we closed. And 5.4 is not that bad. And historically speaking, the building we bought before that was a 6% interest rate. So we actually paid a higher interest rate at the building before that than we did on this building in Passaic. So rates are ticking down.
Yeah, that was, I think, the big lesson for folks too over the past, 2, 3, 4 years is like real estate is debt. Because you could get everything else right, but if that property is not financed properly, and that comes back to bite you, like you were saying, couldn't go any lower, like the rates. It had to go up at some stage. And if you weren't prepared for that, or underwriting deals based on rates that could go up, that's where a lot of people are getting bitten, right?
Yeah, exactly. And, then they got to be buying rate caps or something, which can get very expensive. So yeah, absolutely. And, but it's interesting, as Warren Buffett says, when others are fearful, be greedy. When others are greedy, be fearful. So right now it's real estate's on sale. Prices have come down 20%. Now this is commercial real estate. I'm not talking about buying a house. You want to buy a house in Jersey, forget it. It's like through the roof. Which makes renting more attractive and causes rental prices to increase, actually. So, but it's really a perfect storm for buying real estate right now. And with prices being so low, you marry your purchase price, you date your interest rate. Right? You marry your purchase price, you date your interest rate. Your interest rate you can change. You can refinance. You can do a loan modification. Right? Your purchase price you can never change. Whatever you paid for your property is done. It's history. It's past. So you got to recognize that the more important number is what you're paying for the asset. And if you can get a great price on it now in a down market, and even if you're paying a little more to service the debt for a period of time, but rents are growing, rents are strong, there's value add in the property, then it can make a lot of sense to scoop up an apartment building right now, or commercial real estate for the most part. I wouldn't touch office right now, but residential apartment building is a great space. And it's just it's crazy to me that people are like, oh, stay away from real estate because rates are high. I'm like, well, once rates drop, let's say we get a new Fed chairman in May, and rates start to drop, it's too late, my friend. Like the party's already happening. Everyone's already running out and buying real estate, and all the REITs are going to be going up and so on. And like by then, you're going to miss this window where you can get real estate for a great price. And what's going to happen is you're going to be buying my building for a premium that I've now spent the last 2 years renovating, and you know, bought for a 6 cap, I'll sell to you for a 5 cap, and you know, my investors and I are going to be the ones laughing all the way to the bank. Ideally, that's the strategy here.
So you're seeing even in northern New Jersey, you're seeing some properties, commercial properties, multifamily, down 20% from off their peak.
Yeah, 20%
Wow.
drop. Yeah. Mm-hmm.
Wow. So there's a lot. I mean, obviously a lot of deals that since people put together since 2020 that's been falling apart. So that's interesting. So that's a pretty big price pullback.
Yeah, it's huge, and it took a while to hit. You know, rates went up pretty quickly, and you didn't see the price correlate in the commercial real estate for about 18 months. There was about an 18-month lag. So there was a period of time where it was not a good time to be buying real estate. And you had still compressed cap rates, high interest rates, and it was not really a good combination. Now, cap rates have increased, prices have dropped, and interest rates kind of still are rather high. But now you could buy like a 6 cap, you know, and you're locking in like a 5.5 rate. So you don't have negative correlation between the interest rate and the cap rate. Yeah, so that's not, but at the same time, the revenue on the building has grown. You know, we still see rental prices growing a healthy 5% a year here in New Jersey. In certain markets, generally the closer to Manhattan you get in northern New Jersey, rents are growing 6, 7, 8% a year. You know, and there's a lot of just old vintage inventory sitting in the market. Landlord hasn't put a dollar into it in years, and these just are outdated units. They're ripe for renovation, but they're located in great locations. And you have all this Class A real estate going up around it, these big, beautiful, brand new buildings, and they're charging $4,000 for a 2-bedroom, you know, $3,200 for a 1-bedroom. We come in, we renovate these units, we give recessed lighting, quartz countertops, nice new kitchens, nice new floors, make it a nice, bring laundry into the unit. Yeah, we're not going to have a spa, we're not going to have a swimming pool, but you'll have a parking spot, you'll have a beautiful unit, and when you're sitting in the unit, it'll feel like a new unit. We'll spruce up the lobby and the entranceway and the exterior. So yes, it'll still be an older building without the amenities. You know, not going to have a world-class gym in there, but instead of asking $3,200, we'll ask $2,300. You're paying $900 less per month to be in our building. Well, with that $900 difference, you can get a membership to a spa. You can get a membership to a gym, you know, and still have another $500 sitting left over. So, you know, for someone who's not making $150,000, $200,000 a year, maybe you're in the demographic of like 75 to like 150. Our units make a lot more sense. We're servicing that kind of middle level market of working class America. And that is where we actually need more units. We don't really need more $4,000 rental units. We actually need more $2,200 rental units. That right in there, you know, that 22 to like 27 spot where people can afford, who are making 80, 90 grand a year. And there's a lot more people like that than there are people making 250 or 350.
Yeah. Absolutely. Are there any like tax incentives? Understand that real estate obviously has a lot of tax incentives, but tax credits, tax abatements, kind of like that kind of stuff available in your market too. I know New York has got a ton of programs, grants, that kind of stuff. Is there any of that kind of stuff available too?
Not really. You know, there are, if you are completely gutting a building and like completely redoing it, yes, there are like some tax incentives. There's grants you can get. Now, that's not really our recipe. What we're normally doing, our strategy is more of a cosmetic renovation, you know, updated kitchens and baths. Maybe we improve the layout, recessed lighting, rebuff the hardwood floors. We're just kind of giving it a facelift. You know, now if you totally gut a whole thing head to toe and you're doing all new, then yeah, you might be able to get certain grants and things like that. Tax incentives, again, not really, you know, the old new buildings that have tax incentives like pilots or abatements, but for the most part, older vintage real estate, you know, you're not really getting many tax incentives for it. But there are grants out there we can look into for larger value add situations, but there's generally a lot of hoops you have to jump through, and There can be like added costs. And quite frankly, you don't want to over renovate these units. I mean, if if you're putting too much into them, then it's not going to make sense. You're eventually going to be throwing good money at bad. So we try to cap our renovation costs around 35,000 for like a full renovation of a unit, and then maybe 13 to 15,000 for a partial renovation of a unit. And keep in mind, you want to keep your costs down so you can then keep your leasing price reasonable for the tenant who's moving in.
Aaron, you're saying now is the perfect time and there's a window to buy, right? But there's always some dangers or some element of risk that you have to manage. What are some of the risks or dangers that you kind of see that you have to manage as an investor?
Sure, absolutely. There's always risks, right? And I think what we're seeing now is probably a slowdown in rental growth. We do have a fair amount of inventory kind of from the COVID era hitting the market. So that is getting saturated pretty much as fast as they can buy it. But, you are up against a lot of beautiful Class A real estate. Again, the saturation rate on that is faster than the rate it's hitting the market. But, ideally that doesn't change. And building starts have slowed down significantly in that last couple of years. So I don't see an oversaturation of the North Jersey market. You also have rates. I mean, I don't think they're going to push rates back up, but you always run that risk. Tariffs could cause further inflation, which could lead to an increase in interest rates, which could lead to more challenges with debt. But that would really just push prices further in real estate and make the opportunities greater. And then the labor shortage. A lot of the labor that we use will be of different immigration status. So you're not sure how, more aggressive immigration procedures with the current administration could lead to kind of a labor shortage there. We already saw that actually with some of our labor teams, but now they seem to be back up and running as they usually are. Tariffs with the materials and things like that. I mean, for the most part, materials are what they are. You're just pricing that in. That they go up over time, but we haven't seen a huge increase in materials. They've prices have kind of flattened out from where they were growing pretty rapidly over the last couple of years. In increased inflation, and then red tape. Right, you buy a property in the market, and the rent control laws change. That's probably the biggest risk, quite frankly. And that's what we've dealt with. Where you'll buy in an area, you say, "Oh, the rent control laws here are pretty reasonable. They're manageable as a landlord. They're not that bad. We can navigate them. We understand them." And then, boom, new mayor comes in. He's like, "Hey, we're doing this now." Look in New York City, for example, right? If they get, a socialist mayor in there and he like caps rents or whatever, it makes, even harder for land. Like we would never buy in New York City. It's crazy, but, it would be harder. So we don't want that kind of mentality coming over the river here to Jersey. We want to be able to have private property rights and be able to run our properties within fair reason to, treat the landlords properly, but also be able to move rents with the market, which generally rent control might be limited to like 5% a year, but then there's 100% vacancy decontrol. So when a tenant moves out, you can move rents to fair market value immediately, so you can renovate the unit and lease up forever, whatever the market's bearing, and that's fair and controlled rent control, right? Now when a tenant's in there, in certain areas, I can't jack it up like 20 or 30%. Sure, that's kind of, but I wouldn't anyway, right? Because you're going to lose the tenant, So, but in a lot of the markets we're in, you're thinking like 5% rent control per year, 100% vacancy decontrol, which allows you to turn over units, rent them for fair market, and reposition the asset successfully.
Aaron, we talk a lot about business. We talk a lot about investing, cash flow, of course, on the Cashflow Ninja podcast.
Yeah.
But we like to talk a lot about living and leaving a legacy. So I always ask this question: if you cannot pass on any money to future generations and you're only allowed to pass on 3 principles and values to them to achieve happiness and success, what would they be?
Okay. Great question. I would say, first of all, having a higher power. I've gone through a lot of challenges in my life. My faith has been phenomenal. I think it's extremely important to have a higher power, and whatever religion is that's a good fit for you. But as far as my children, I try to raise them in a good Christian household with a higher power, and have that community, that church community that's very powerful. I mean, I wouldn't be where I am today without that belief in God. And if you don't know who your God is, then it's probably money or your Instagram likes or, the car you drive, because we all have a God. We all serve someone or something. And I think it's best to know who that God is and make it a God that it believes in love and leading through love. So I think that's the most important thing. Secondly, I'd say integrity. I was teaching my 3-year-old son the definition of integrity the other day. Never too soon to start. And, it gets you thinking about your own integrity, and that's the most important thing. I mean, we as a society, we don't hate more like someone who says something that does something else, like a lot of politicians do. It just drives us crazy, and you see that so much with politicians and leaders and celebrities and whatnot. It's almost like commonplace, just like have a lack of integrity, and it's so important to have your word, the value of a handshake. You say you're going to do something, do it, and do it with purpose. If you say you're not going to do something, don't do it, and that's extremely important. And then finally, probably, you can kind of roll into the higher power, treating others how you want to be treated. So I'll roll that in with that one. But thirdly, I think a work ethic, I think laziness is one of the most unattractive, unappealing personality traits or habits one can have. Working hard, providing value. And listen, you don't have to be running a business or trying to buy big multi-million-dollar buildings. You could, just being good at what you do, and whether that's the smallest thing, it is so important. I was thinking the other day, like I was watching the Garbage Men commentate. I was like, what if they didn't show up for a week? We'd be screwed. Like there'd be rats everywhere. We'd be dealing with disease and filth. Like we need to value those hard working men and women that make America run, and just no matter what you do, whether white collar, blue collar, it doesn't matter. Do it with perfection, do it with interest, do it well, do it with passion. And work hard. Having a good work ethic and applying yourself is so extremely important. And I want to instill that in my son, and I want to make sure I show that as a father and a man as well.
Aaron, where can my listeners and my viewers learn more about you? Where can they follow you and stay informed of all the many projects that you're involved with?
Sure. So our website is peoplescapitalgroup.com, and you can check out all of our content there. We have video series, we have ebooks, we have different email newsletters you can sign up for. And then we also are on YouTube. We're very active on YouTube. We do educational webinars and masterclasses, investment classes. We do podcasts and the Passive Cashflow podcast every 2 weeks. So that's on Spotify, iTunes, all the major platforms. YouTube as well. So it's People's Capital Group. You could plug us into YouTube. You could check us out on the Passive Cashflow podcast as well. And then peoplescapitalgroup.com is where it all starts. You can check out our investment opportunities, get in touch with a member of our team. We're generally buying about 2 apartment buildings a year. They fill up very quickly. So we're buying one right now in Hackensack, New Jersey. So check that out. See if it's fit for your investment goals.
Sounds good. Aaron, thank you so much again for coming on the show and sharing your journey and your knowledge and providing so much value for all of my listeners and my viewers.
Thanks, MC. Have a good day, my friend. See you.
And thank you to all of my listeners and my viewers for, again, spending your most valuable resource, your time, once again with me on the show. Everything Cashflow Ninja is at cashflowninja.com. That's cashflowninja.com. We've got over 1,000 podcast episodes. We have 4 books, reports, webinars, and much, much more, all at cashflowninja.com. And don't forget to subscribe to the #1 newsletter in the alternative wealth strategy and alternative asset investing space, the Wealth Dojo. You can subscribe to the Wealth Dojo by going to cashflowninja.com/subscribe. Until next time, live infinitely.
This presentation is for educational and informational purposes only. The information being presented and considered does not consider your particular financial objectives or situation, and it does not make personalized recommendations. This material is not intended to replace the advice of a qualified tax, and legal advisor or other qualified professionals. And you should not use the information in place of a customized consultation with a licensed professional regarding your specific personal financial objectives, situation, and needs. We believe the information provided is reliable, but we do not guarantee its accuracy, timeliness, or completeness.